Hi everybody, this is AJ speaking. Today I want to discuss Palantir. At time of this recording, the stock trades at $153 per share. And this made Palantir one of the best performing stocks in the stock market over the last 5 years with a return of 1,432%. This video is entirely about putting Palantir's current valuation into perspective. But before we dive in, let's take a look at the valuation. You can see at the bottom half of the slide, Palantir's current market cap. This is $361 billion or $362 billion rounded. In this video, I will not be going into what Palantir actually does. This will be for a future video. Also, since I included Palantir now into my core coverage, there will be a lot more research on Palantir in the next couple of months. With that out of the way, let's dive in. Here on this first slide, you can see in dark blue Palantir's historical revenue generation. Up here underlined, you can see the year-on-year growth rate, and the top line is quarter-on-quarter growth rate. And down here, you can see the full year totals, total revenue, and the year-on-year total revenue growth rate. So in the last 3 years, 2022, 2023, 2024, Palantir grew 24%, 17%, and 29% respectively. The first quarter of this year, 2025, was quite strong at 39% year-on-year growth rate. And please note, that was the strongest year-on-year growth rate in at least 3 years for Palantir. So this forecast that will be presented throughout this presentation assumes a slightly higher growth rate than this record year-on-year growth rate for every quarter after Q1 2025. And that year-on-year quarterly growth rate is 40%, as you can see up here. Currently, Palantir's last 12 months total revenue is just over 3 billion. And this forecast implies that over the next 2 years, that trailing 12 months number will double. And you can see down here, so this forecast reflects just over 4 billion in total revenue for 2025, 5.6 billion total revenue in 2026, and then just under 8 billion in 2027. If we jump real quick to analyst estimates, you can see down here revenue estimate. The average estimate is right now at 3.9 billion. So the forecast that you see is ahead of that number. And then they forecast for 2026 slightly over 5 billion. And you can see that this forecast is significantly ahead of the analyst consensus at 5.6 billion. That's roughly 12% ahead of the average consensus. There isn't a robust 2027 consensus right now, but arguably, if there was one, this forecast you're looking at is also probably materially ahead of that consensus. Since the argument is, if you look at analyst reports, you can see that they expect a weakening growth rate. They still expect a very strong 2025. That's why the forecast you're looking at is broadly in line with the consensus, but in 2026 there's a significant delta. So this chart shows you the year-on-year growth rate on a quarterly basis for total revenue, and you can see that when we go from 2022 to 2023, you can see that Palantir's year-on-year growth significantly slowed temporarily and then started to accelerate again and reached a new peak, as just mentioned, in the most recent quarter. So the big question is this now a true peak, or is it just a local peak and the train continues to go, sorry, not the train, the company continues to go up, or was Q1 2025 pretty much as good as it's going to get? If Palantir keeps accelerating year-on-year revenue growth, this revenue forecast that you look at is too conservative. If Palantir can maintain the current peak rate, then this revenue forecast is in line. But if the current high is just a temporary high, then this forecast will materially overstate Palantir's revenue outlook. Then we move on to gross profit. Just a quick recap. Gross profit is simply revenue less cost of revenue. Just real quick why it matters. That the moment you become gross profit or gross profitable, so you're not making gross losses, when you scale, you can increase your earnings. But if you're gross loss making, no matter how much you scale, you're always going to be loss making. I'm slightly simplifying, but broadly speaking, this is kind of the rule. The exception is when we get into capacity utilization and other things. But broadly speaking, you want to be gross profitable. Otherwise, typically the scaling is not even helping very much. So when we then look at these gross profit numbers, so in 2022, Palantir generated just under 1.5 billion. 2023, it grew 20% to just under 1.8 billion. And then in 2024, it grew another 28% to exactly 2.3 billion. And the forecast you're looking at forecasts 41% year-on-year growth rate to gross profit of just above 3.2 billion, goes to 4.6 billion 2026, 42% growth rate year-on-year, and then another 42% to a quite large 6.5 billion gross profit base in 2027. This slide then shows you what this means in terms of gross margin. Quick recap: gross margin is gross profit divided by total revenue. Palantir has an exceptionally high gross margin, but this is normal for software businesses. And you can see Palantir's gross margin has seen quite some variability in the last couple of years. So in the fourth quarter of 2023, it was at a last 3-year high at 82%. Then it came down in December 2024 to just 78.9%, and then it recovered sequentially to 80.4% in March 2025. The forecast, as you can see, then assumes a continuous improvement to a new all-time high at just over 83%. And when you look down here, you can see that on a full year basis, at least in the last 3 years that are considered in this historical review, Palantir has never delivered above 81% gross margin. However, the forecast projects for 2025 just under 81%, just under 82% in 2026, and then nearly 83% in 2027. So this slide then puts this gross margin into perspective. So just as I said, the forecast expects at the end of 2027 gross margin expands to 83.2%. And if we compare this to the median gross margin that is delivered by the highest gross margin Magnificent 7, so that the top gross margin Mag 7 is Meta. They had over the last couple of years median gross margin of 81.3%, followed by Microsoft, just under 69% gross margin. Alphabet, so Google, is just under 44%, and Apple is Apple and Alphabet almost the same. Alphabet just rounds nicer, so they're both 44% gross margin businesses. So basically, big picture of this chart is that Palantir is already outperforming everyone except Meta, but Meta is the leader in terms of gross margin in this group of extremely highly performing companies, extremely strong franchises. And then here you also see how does this compare with this latest reported. So Meta outperforms Palantir in terms of gross margin currently. However, the forecast that you look at projects Palantir to outperform Meta in a couple of quarters, even though Meta is currently near peak gross margin performance. Up here you can see there was a very strong single quarter, and then there is Palantir's last 12 months, so TTM is trailing 12 months, it was right at 80%. So you can see that the forecast is optimistic, but not totally unrealistic or something like that. Then we get to operating profit. So operating profit is when you start from gross profit, you deduct sales and marketing, research and development expenses, general and administrative expenses, then you get to operating income. And these three expense items that I just mentioned, they are called operating expenses. So simplistically, you could also just say gross profit less operating expenses is operating income. What I skipped in this analysis is showing how the efficiency of Palantir increases as it grows. I will cover this in more detail in the future. So let's look at the net result. So in 2022, Palantir was still operating loss-making, 161 million. In 2023, it improved significantly, was positive 120 million operating profit making, and then was improved further. 2024 grew to 310 million. So it's a significant, almost 160% year-on-year increase. Then this forecast translates into an even higher growth rate in 2025 of 214% to 976 million in operating profit. Another slightly more than doubling in 2026 to just under 2 billion operating profit. And then a very large, still very large year-on-year growth rate in 2027 of 84% to just over 3.6 billion operating profit. So truly staggering numbers. So keep this in mind. This forecast is I don't know the right word, but it's optimistic. It basically projects that Palantir will rip everyone's face off in terms of revenue growth, profitability, earnings, truly stellar numbers. Then we skip discussion of non-operating items. They're not that important in Palantir's case. We get to profit before tax. I'm not going to go through each of these numbers. They're not that important because it's better to jump directly to the one that really matters. It's not even this one. This is net income. that's the one that is very important, is shareholder net income. But even that one, we have to adjust. And this is what you see down here. So to get to a total non-GAAP adjusted net income, you have to add back share-based compensation, then the employer payroll on share-based compensation, the tax, and then there are a few relatively smallish items relative to the other two items. There are other adjustments. In Palantir's case, you need to know that the employees get significant compensation in shares, and that's why there's a huge add back in non-GAAP adjusted earnings. I know a lot of investors don't like adjusted numbers, or non-GAAP numbers as they're also called. But when you want to do valuation, or what you see later in analysis, just by doing a ton of back testing, I found that using the adjusted numbers gives you a much better result than anything else. So that's why we use it. But from a shareholder value perspective, you have to keep in mind that this very high compensation for employees does create meaningful dilution. And a significant percent of the company's net income is effectively paid away to employees. But what you see here are the non-GAAP adjustments that we need to add back, and you can see they're quite substantial. So for example, in the first quarter, there was, if we jump back real quick to shareholders net income, so Palantir generated 240 million shareholders net income. And then if you want to go to adjusted shareholders net income, you need to add back 120 million, so this is a massive percent. And then you get to the adjusted shareholders net income of 334 million. And this is ultimately the number that is most useful if you want to do any kind of valuation analysis. So if we just real quick go through these numbers, in 2022 was positive 135 million. So if you remember, when we just look at unadjusted numbers, it was still negative. Then in 2023 increased to 572 million. Then in 2024 exceeded just slightly 1 billion. This forecast translates into just over 1.7 billion this year in 2025. And then there's a 62% year-on-year growth rate implied to just over 2.8 billion in 2026. And then at the end of this forecast, at 2027, adjusted shareholders net income increases to 4.4 billion with a massive 58% year-on-year growth rate. Again, truly staggering numbers. But to make use of these numbers for valuation purposes, we need to translate them into a different unit. And this is why we need this. This is a projection of the number of shares outstanding. And as you can see here on these year-on-year growth rates, the forecast assumes there's a slowing in the growth of shares. And the way to think about it is Palantir will become worth more on the stock market in theory, and then they will continue to pay more employees share-based compensation, and probably bigger share-based compensation, but the growth in market cap should slow down the growth in Norsche. In a separate video I will show the relevant model for that, but in this video I will skip it, otherwise it becomes too long. And then when you divide the adjusted shareholders net income by the number of shares outstanding I just showed you, you get to adjusted earnings per share. What you look at right now, this is on a quarterly basis. So for example, this forecast projects for the second quarter of 2025 16 cents per share. In the first quarter, Palantir reported 13 cents per share. If we jump quickly back to the analyst estimates, so here is earnings estimates. Average estimate is actually for the second quarter 14 cents per share. This is actually meaningfully below the forecast you're looking at. Again, this forecast translates into 16 cents per share, so it's significantly more aggressive. So if we jump back again here, and then when we look at the third quarter, it's also 14 cents, and this forecast is at 17 cents. And then look at the full year numbers. So the full year is at 53 cents for 2025. In 2026, sorry, I misspoke. The average is at 58 cents for 2025, and for 2026 is at 73 cents. So this 58 and 73 cents compare against this forecast 66 cents and $1.02. So this forecast you're looking at is significantly ahead of consensus. Just keep that in mind. If Rivian keeps materially beating consensus, then it just gets to where this forecast is. I repeat, Palantir has to materially double-digit beat every quarter to get to what you look at right now. It's a key interim finding, and why we get to it in a little bit later. But before we continue, just real quick on the mechanics. So this chart shows you the quarterly earnings, and here I highlighted an example. So if you add up the next 4 unreported quarter as of today, so this is the second quarter of 2025, third quarter of 2025, fourth quarter of 2025, and first quarter of 2026. These are the next 4 unreported quarter as of today, and this forecast translates into 76 cents per share. This is a number that is useful because with that number you can already work out a forward PE multiple. A forward PE multiple, or a next 12 months PE multiple, or a 1 year PE multiple. This is all the same thing. These are all synonyms. And for the most widely used valuation metric, which is the PE multiple, and the classic form, the 1 year PE multiple, but there are other forms of PE multiples I might discover in a future video. So before we go on, remember the 76 cents. Here on this slide, you then see the quarterly earnings all translated into next 12 months. So these are not quarters anymore. These are from, so the way to read this chart is you see the different quarterly steps. But when you look at, for example, this number, May 2025, when you read 76, so in May 2025, Palantir reported the first quarter of 2025. The first quarter closed in March, but the number was only reported in May. And from the reporting date, once the first quarter has become knowledge of the market, so the next trading day, the next 4 quarters jump to 76 cents. So this is what we have right now. So it's just the sum of these quarters up here, and you see these quarters here in this quarterly chart. And here is just a summation on a rolling quarterly basis. But again, all forward-looking. I hope this is clear, because this is an important step in translating quarterly numbers to 12 months forward-looking numbers. But to make a share price corridor projection, we need a continuous metric, not just one that occurs 4 times a year. And this is what this chart shows you. So this analysis extrapolates linearly between each quarter the next 12 months earnings number. And here, for example, you see again marked the 76 cents. So on the first day post earnings announcement, post Q1 2025 earnings announcement, the next 12 months earnings jump to 76 cents. But then, and this is an important kind of refinement to this analysis, then you should assume that until the next quarter, the next quarter earnings is not fully priced in at time of reporting, but as the reporting date approaches, more and more of that quarter is being priced in. I don't know, because of company announcements of new deals, etc., blah blah, strong management interviews. So the method I'm applying reflects all of this reduced uncertainty as a quarter comes nearer. Of course, you can criticize it. Oh, how do you know they meet the target? You should know that Palantir is one of the companies that provide very they provide next quarter guidance in a very narrow range. And in a future video, I will cover the sandbagging or lack of sandbagging, and then it will all become clear. But again, to keep this video as short as possible, I will skip that step. So, and then ultimately, when you go for each quarter on quarter, so this exercise on reporting dates, etc., that is the most accurate way you can do a multiple, and it's more accurate even than what you can pull up on Bloomberg. Then you get to this earnings stream, or now we have a continuous earnings metric that we can use to generate a share price corridor that takes into consideration timing effects, with one big exception, and one I will mention later in this video. But before we can do a share price projection, we need the other key ingredient, which is a multiple. And this is what you see here. So this is Palantir's PE multiple over the last couple of years. And where possible, this was based on Palantir's true PE. I will not explain what the true PE is here. I've done this many times before, but it's basically the PE that you get if the consensus was 100% correct. So it takes out any over or underestimation bias by Analyst. This is another superior method to what you can look up on Bloomberg. I mean, you can, but from my experience, most people don't actually know how to do it. So let's look at this chart first. So in 2022, you can see that Palantir's multiple was kind of totally crazy, but there's a very simple mathematical reason. This was the period when forward earnings in Palantir for the first time became positive, and you should think about it this way. You had like let's say 2 loss-making quarters, and then you had like a tiny profit in one quarter and maybe another one. So you had like 4 consecutive quarters, 2 loss-making, 2 slightly profitable, and you had like a tiny surplus as a result, and then of course you have a denominator effect. You have the share price divided by this very small number, and then this gives you like crazy multiples. This is absolutely not uncommon for high growth stocks, where people can see the potential of the company and they price the company accordingly, that the multiple in this early phase is like completely nuts. During this phase, you cannot use PE multiples and a bunch of other multiples. But again, this is a topic for another video. Just telling you this as an explanation. This is completely normal, nothing to be worried about. And then as Palantir grew, it kind of generated a more like normal valuation. And then over time, the stock gained momentum. It became especially more and more popular amongst retail investors. I mean, I remember, I think 2 years ago, hardly anyone knew Palantir. And I think roughly a year ago, it became really popular, and kind of everyone, even people who don't deal that much with stocks typically, knew all of a sudden about the stock. And I think this is what you see, at least partially, in this multiple inflation. And right now, what you see is that Palantir trades at just under 200 times earnings based on this forecast. I repeat, just under 200 times earnings on this forecast. And as we established, this forecast is number one, significantly ahead of consensus, and really, really aggressive. I mean, not impossible, but it's very aggressive. And even on this strong outlook, the multiple is that high. The reason why this is so important is if you just think about the PE math, it's very simple. Divide the share price by the earnings. The bigger the earnings, the smaller the multiple. This forecast translates into very high earnings. So the denominator, so the number in the bottom, is very big. But still, because Palantir's share price is now so high, this still translates into a huge multiple. I estimate that Palantir's multiple is probably even 10, maybe 15% higher than Tesla's. So then let me just real quick explain all these lines. So you can see in the title, so this looks at the historical PE multiple and then also the 12 months median. So the 12 months median, so you can see down here, this is like several years, but these horizontal lines only look at the last 12 months, but then draw them across the entire chart. So the median right now, and you can see it here, so currently July 17th, 2025, the median is 117, 118 times. The standard deviation is 41 times, so plus minus 41. I mean, technically, what you should use is the mean, but again, I've done a ton of backtesting, and the median is results in better results. But mathematically speaking, this is not exactly a correct definition. But for practical purposes, I think it's perfectly fine. And then you have so the one-time standard deviation is like, let's call it roughly 2/3 of the time the stocks should be trading in that range. So this is marked by these two green lines. Right now, the stock is clearly significantly outside these green lines. It exceeded the top one-time standard deviation. So it's in a, the way to put it is, it's right in an unusually high valuation level. I'm not talking about the stock, I'm just talking about implied valuation. That's key. And then when you look at the 1.5 times standard deviation, so even wider range, and that at the limit is even rarer situation. This is only a low double-digit % of the time the stock should trade in that range, but even that range is exceeded and is now outside the 1.5 times standard deviation. So to sum it up, right now the stock trades at a valuation level that is quite rare relative to the last 12 months. So now the argument is, but the AI momentum, stock market momentum, blah, 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 has picked up momentum. Shouldn't be the stock priced on this stronger sentiment? I think there are a lot of things that are in favor of this argument and a bunch of things that are against it. The point of this presentation is not to argue for one or the other. It's just to show you kind of the gamut of outcomes. But before we go a step further, this slide is the exact same slide as before, but more zoomed in. What you can see is that first of all, it's just under 200, significant above the median, as I said. But then let's talk about what does this really mean. For example, NVIDIA is at currently $172 or something like that, trading roughly around 36 times, 37 times 12 months earnings. So Palantir is like a multiple of that, so extremely expensive. Tesla is meaningfully below. Tesla probably around 160, 170-ish. Someone like Apple is significantly below 30, or Alphabet, Meta, a couple of the other Max 7 closer to 30. So basically the Max 7 excluding Tesla and Palantir, they're typically somewhere 25 to 35, roughly speaking. So relative to these stellar companies, Palantir is still at a meaningfully higher valuation level. But now let's look at the valuation. If we do what we just discussed, we compress it down not to a 12 months multiple observation, but just at the last 90 days. So this is again the same chart, but you can see now these red and green lines have moved because these lines only consider the last 90 trading days. And a couple of things have changed now. So down here in blue, you see that the last 90 session median is 166 times. Based on this forecast, again, this is ahead of consensus. So the consensus multiple would be even higher. And even relative to that median, and the current valuation is 13% above that relatively short-term historically implied median. So with all that out of the way, just before we get to the share price projection, so we got the earnings stream we discussed earlier. We looked at the multiple. We established the multiple relative to very high performing stocks is quite high. I think we also established, number one, the forecast you look at is significantly ahead of consensus. It is very aggressive, not unrealistic, but I mean, they really have to deliver. So all is like, let's call it, I don't want to say maxed out, but this is really aggressive. So then on this first slide, we look at really long-term, several years out, based on the 12 months median. You can see the corridor that it's implied by the standard deviation 1 times and 1.5 times, basically the multiple ranges we just looked at, and then you add the earnings extrapolation that we discussed earlier. This is then the share price corridor. You might look at this and think, oh, it looks crazy, this is so wide, but this is just a function of the volatility of the multiple, the very large multiple, of course. And based on this methodology, you can see that the share price currently is outside 1.5 times standard deviation, so it's a very rare occurrence. And you can see the February sell-off. The February sell-off this year was caused by the current US administration announcing global tariffs. We saw a market-wide sell-off, and you can see that this methodology kind of nailed an exit or trim point, at least temporarily, because now the stock is already materially higher than it was back then. If this analysis would be in line with what's going to happen, then it would signal that you would be well advised to trim and wait for slightly lower re-entry. But this video is not trading advice, just trying to provide some valuation perspective. But then again, this is the 12 months median multiple, and again the AI sentiment grew stronger and the market overall moved to a higher sentiment level. So that's why I look at the 90 days median multiple. This is what this chart shows you, and both charts, they use the exact same earnings, of course. And you can see how it's also borderline at the limit of 1.5 standard deviation. Again, very rare based on this analysis. But now let's get to the core of the matter. What would be the implied next 12 months or next 24 months price target for the company? If we start here with the 12 months median multiple, if this is a better guide, over the next 12 months, it is implied that, again, based on this very strong earnings outlook, there would be a 9% downside. So again, I just want to make very clear what this means. If Palantir can deliver this phenomenal earnings growth, this forecast projects ahead of consensus, but falls back for whatever reason, worse market sentiment or whatever, some black swan gets back to a more average median trading level multiple, then the downside over the next 12 months will be 9%. So if you buy today, you would lose some money. If you trim today and buy in 12 months again, you would be better off. Basically, this is what this chart says. But important to remember, if you don't want to trade around these phenomenal stocks, in 2 years, if everything I just said was true, you would still be looking at 40% upside. But again, this is based on a very aggressive forecast. But then again, let's look at what the more recent implied average median multiple implies. So this chart shows you then the implied share price corridor based on the more recent last 90 days median multiple. And you can see that if the strong momentum continues, Palantir can defend its high multiple, can deliver on this very aggressive forecast, beat earnings in low double digits basically every quarter, then you'd be looking at about 30% upside over the next 1 year, and over the next 2 years, almost doubling, so 98% upside. So this is now the end of this video. I hope this was helpful. If you like this quantitatively driven research, I recommend subscribing to my YouTube or X channel. My handle is alojoh, which you can see down here at ALOJOH. If you want to take your investing to the next level, I strongly recommend that you also subscribe to me on X. With that out of the way, thank you very much for watching. See you next time. Bye.